Welcome back to the Deep Dive. Today, we are really cracking the code on something that I think hits almost everyone who's trying to get ahead.
Yeah.
We're talking about navigating the U.S. tax system when you've got more than one income stream. Whether that's, two different W-2 jobs or you're running that side hustle alongside your main gig.
Right.
So let's just start with the basics. The whole U.S. tax system, it's what they call pay-as-you-go, right?
Exactly. You're meant to pay your taxes as you earn the money. It happens one of two ways. Either through withholding from an employer, on a W-2,
Okay.
or through making what are called estimated tax payments if you're self-employed.
And this is so important because there's a fundamental flaw in how this all works, isn't there?
There really is, and it can be a costly one. Basically, every single income source you have treats you as if it's the only one. So if you have two jobs, or a job and a side business, your total income might push you into a much higher tax bracket, but neither of those income sources is prepared for that.
So they're not talking to each other.
Not at all. And that almost always leads to underwithholding. Then you get to tax time, and if you owe the IRS $1,000 or more, well, you're not just paying that bill, you're probably facing penalties too.
And nobody wants that April surprise. So our mission today is to get past the fear of these forms, the W-4, the 1040-ES, Schedule SE, and really give you a strategic roadmap. Let's start with, I think, the most common headache. Just juggling two W-2 jobs.
Right. So when you start a new job, you fill out that form W-4, and your employer's payroll system, it looks at that and it just assumes, okay, we need to account for your standard deduction.
The whole thing.
The whole thing. And it assumes your income is going to fall into those very low, 10% or 12% tax bracket.
And then you start that second job,
Yep.
and that new employer,
Yeah.
they do the exact same thing.
It's the exact same thing. It's like each of them is giving you a slice of pie that's supposed to be your entire meal. And your combined income just fills up those low tax buckets way faster than the system expects. Suddenly, a huge chunk of your money is actually being taxed at, say, 22% or 24%, and nobody planned for it.
So this is where we have to take control of the W-4 ourselves. How do you, as the employee, basically wave a flag and tell the system about this double income problem?
You've got two main strategies here. The first one is the simple approach. On your W-4, in Step 2C, there's a little checkbox. If you check that box on the W-4 for both jobs, it immediately tells the payroll system to withhold tax at a much higher rate. It basically says, hey, assume my standard deduction and low brackets are being used somewhere else.
That seems like a pretty good fast fix.
Yeah.
But what if the jobs pay really different amounts? Or maybe you have three jobs.
That's the catch.
Could that simple box maybe over withhold your money? Or worse, still under withhold?
It could, and that's when you turn to solution number 2, which is far more accurate. The IRS has a tool called the Tax Withholding Estimator. You can find it at irs.gov/W4app. You plug in your total income, your deductions, your credits, and it spits out the exact dollar amount of extra withholding you should put on your W-4.
And that's the gold standard for getting it right.
It absolutely is.
But there's a detail here I think people miss. If you do this mid-year, you update your W-4. You have to remember to submit a new W-4 in January, right?
Yes, that is such a crucial point. It's not a one-time set-it-and-forget-it fix. You have to re-up it for the new year.
Okay, good to know. Now, speaking of people earning more, what about Social Security?
Yeah. So for 2025, the wage limit for Social Security tax is $176,100.
And what does that mean?
It means each of your W-2 employers is required to withhold that tax up to that limit. So if your total combined wages go over that amount,
You're going to overpay. So if I make $100,000 at Job A and $100,000 at Job B, I've paid way too much in Social Security tax.
you have. But, and this is the good news, you don't have to go chasing your employers for it. That extra amount you paid gets claimed back as a refundable credit right on your tax return.
Oh, that's actually a pretty simple fix. A rare bureaucratic win.
It is.
Okay, so we've got the W-2 situation handled, but what if that second income isn't another job? What if it's your own business, that side hustle?
Now you're in the world of estimated taxes. And this is, it's a big mental shift.
Right.
When you're self-employed, a freelancer, a contractor, you are now responsible for sending your own taxes to the IRS every quarter.
Every quarter. And it's mandatory, right?
It's mandatory if you expect to owe at least $1,000 in tax for the year after you subtract any withholding from your W-2 job. And you also have to meet what's called the safe harbor rule.
The safe harbor, what's that?
It's your protection against penalties. You have to prepay either 90% of your current year's tax bill or 100% of what you paid the prior year.
100% of last year's tax.
Right. And for higher earners, if your adjusted gross income was over $150,000, that second number actually bumps up to 110% of your prior year's tax.
Okay, and for most people doing a side hustle, I think the big shock is the self-employment tax.
It really is. With a W-2, your employer pays half your Social Security and Medicare taxes, but now you're the boss.
You pay both halves.
You pay both halves. The total rate is 15.3% if your net earnings are over $400. That's 12.4% for Social Security up to that annual limit, and 2.9% for Medicare with no limit at all.
That 15.3% really sounds painful. Is there anything built into the system to ease that blow?
There is, and it's a really smart mechanism. The IRS recognizes you're acting as both employer and employee. So first, the tax is only calculated on 92.35% of your net earnings.
Okay, small break there.
A small break. But the real benefit is that you get to deduct half of your total self-employment tax bill when you calculate your adjusted gross income, your AGI.
Oh, wow. So the tax code is basically saying, we see you paid the employer's share, so we'll let you write that part off as a business expense.
That's exactly it. And that deduction can significantly lower your overall income tax. It's a hugely valuable detail.
So how do you actually pay this?
Quarterly. The deadlines are April 15th, June 15th, September 15th, and then January 15th of the next year. You can pay online, which is what I'd recommend, through IRS Direct Pay.
But what if your income is all over the place? You have no clients for 3 months and then land a massive project in December.
That is where that safe harbor rule becomes your best friend. If your income fluctuates, just paying 100% of last year's tax liability in 4 equal installments is usually the safest way to avoid a penalty.
Even if you know you'll owe a lot more at the end of the year.
Correct. Because if you try to match your payments to your income but you miscalculate an early payment, you could still get a penalty for that period.
Is there a more precise way?
There is, but it's complex. It's called the annualized income installment method. It involves a lot of calculations on Form 2210, but it perfectly matches your tax payments to when you actually earned the money.
Okay, let's talk about the silver lining here, the deductions. That 15.3% tax is only on your profit.
Right. And every legitimate business expense reduces your profit, and expense just have to be, in the IRS's words, ordinary and necessary for your business.
What are some of the big ones people should know about?
Well, the first one we just talked about, you get to deduct half of your self-employment tax. That's huge. Then there's the home office deduction.
Ah, the famous home office.
It's powerful, but you have to be careful. The space must be used regularly and exclusively for your business. So your living room couch or the kitchen table, that's not going to fly.
What about driving? Vehicle expenses can be huge.
Massive. You can use the standard mileage rate. It was 67 cents a mile in 2024. Or you can track all your actual expenses: gas, repairs, depreciation. For most people, the mileage rate is just easier as long as you keep a detailed log.
And then you have other things like business insurance, supplies, maybe paying an accountant.
Yeah. Exactly. But probably the most strategic move for a successful side hustler is retirement contributions. Setting up a SEP IRA or a solo 401k allows you to put away a large chunk of your self-employment income, and those contributions are typically deductible. It's a major win-win.
That is a huge takeaway. To not get swamped by all this, what are the basic organizational steps?
And number one, without a doubt, get a separate bank account for your business. It makes tracking everything for your Schedule C infinitely easier.
And use technology, I assume.
Oh, absolutely. Use an app to track your mileage. Use an app to scan and save your receipts. And just be proactive. You have to report all your income, even if a client forgets to send you a 1099 form.
Right.
When you connect all these dots, the reason this planning is so vital is that your combined income just sends your tax rates soaring. It can affect your eligibility for all sorts of other credits and deductions. Ultimately, you, the earner, are responsible for making sure the government gets paid on time.
So what does this all mean for you, the listener who's out there juggling all this? It means you just can't be passive about your taxes anymore. You have to get proactive and use the tools available. That IRS tax withholding estimator, that is probably the single most important step you can take to avoid a nasty surprise at the end of the year.
Absolutely. And that final reminder, update your W-4 whenever your situation changes. And lock those quarterly deadlines, April 15, June 15, September 15, January 15, into your calendar for any self-employment income.
Which brings us to our final provocative thought for you to explore. Is aiming for a big tax refund actually a smart strategy? A lot of people feel a sense of security getting that large check from the Treasury. But what a big refund really means is that you gave the government an interest-free loan with your money all year long. Money you could have used to pay down debt, to invest, or just to help with your monthly cash flow. Is that feeling of safety really worth the opportunity cost? Something to think about. We'll see you next time on The Deep Dive.